Hello, everyone. Hope everyone is doing well. Today, we're going to learn about exchange rates in an open economy. So, we're going to see what is exchange rate, how is it determined, and how does that affect other macroeconomic variables. So, in our chapter where we studied GDP, we learned that Y, which was GDP, equals C plus I plus G plus NX. So if we think about it, Y was called income or expenditure. Let's say it's income for us. So this is the total income a country is earning. C is our consumption. This is how much we consume on, let's say, on goods and services. Investment is what we call amount that is used to create capital, goods that help us produce more goods and services later in the years, maybe in this year or next year. We have government spending. So part of our income goes to the government that government uses to spend on different services. And finally, we have net export, which was basically export minus imports, which is we said X minus M. Now, if we rearrange it, we can write it as Y minus C minus G. That is, we subtracted Y, C and G from both sides. That will equal to I plus NX. So if I'm thinking about, let's take an individual. If this is my income, this is the amount that, let's say, I pay to the government as taxes, and this is my consumption, then whatever I'm left over, if I have some money left over, that will be my savings. So then this part, whatever is left over, is savings. Now savings then is equal to what we can say is investment plus net exports. So in our case, we can see that whatever we save, part of it goes to investment, part of it may go to net exports. Now in a country like US, we can see that if I write it in equation form, then it is X minus M. Usually in the US, this part is going to be negative. We import more than we export. So in that case, then, if I want to maintain a certain level of investment, or if I just save a certain amount, let's say I'm saving only $1,000 and I am investing, or let's say I want to invest $1,200, then the only way I can do it is if my net export is negative $200, which means I'm importing more than I'm exporting. Now this looks a little odd. It's like, why is, if investment is higher, like usually if my economy, let's say, was closed, if there was no net exports, in that case, we'll write it here, in a closed economy, that means we don't trade at all, savings will equal investment, which means that whatever I save, if I have extra money, I'll probably invest it to create more capital. This will make my savings grow even more. However, whenever we have an open economy, which is an economy that allows us to trade with other countries, we can see that we may have lower savings. Savings may be less than investment. So if we see that, we can write if X is less than M, or which implies that X minus M is less than 0, so we are a net importer, then we will see that our investment is greater than savings. So we invest more than what we save. Conversely, if we have X is greater than M, which means that X minus M is greater than 0, so that means we are a net exporter. In that case, we will see that savings is going to be greater than investment. So from here now we see something else is happening here. So why is the trade market, the market of trade with international other countries, why is that related with the level of investment? So from here, we now come up with another concept, which we called net capital outflow. Net capital outflow, or NCO. The formula here is, value is, it's the purchase of foreign assets by citizens of a home country. So if an American buys, let's say, a factory in France, that would go in the first part, minus the purchase of domestic assets by foreign citizens. So if if a German citizen buys a factory in America or invests in America, that would go in the second part. If I have this NX, this is again X minus M, this is creating a deficit in goods if we are importing more than what we are exporting. So that money needs to come from somewhere because now we are buying more goods from abroad, so we need to pay for it. How does that come from? Well, this money has to come from when people, maybe foreign citizens, are giving us money. So maybe they're investing into the US, so this economy is in equilibrium if net exports, or NX, equals NCO. To see why this is so, let's say we have two countries, the US and Germany. So the US is selling, let's say they're trading in two goods, corn and cars. And so the US is selling to Germany 1,000 corn, and in return it is getting 500 cars. So in that case, my net export will be 1,000. Actually, let's make it 1,500 cars. So then it will be 1,000 minus 1,500. This is from the US perspective, so my net export will be negative 500. If I think about in currencies, I need 500 extra. Germany's currency is euro, 500 extra euros in order to make this trade happen. So then, from NCO, from the net capital outflow, basically what is happening is Germans are now then giving us money. They're investing money into the US. So because that money is coming into the US, I can use this additional amount to buy this extra 500 units of cars. So this helps us to see that the goods market is related with the capital market that we see here. Now the net capital outflow also affects our exchange rate. Now what is our exchange rate? Exchange rate is the rate at which a currency trades with another currency. Usually when we go abroad, we cannot use US dollars. So what we do is we convert our US dollars to other currencies. And it is usually converted at a specific rate. So let's say if I go to, from the US, if I go to somewhere in Europe, let's say there, if I want to buy an additional euro, it could be that $1 will give me maybe 75 cents in euros. Or if I go to, let's say, Japan, maybe $1 will give me 130 yen. So if I pay $1, I should get 130 yens. Or let's say if I go to another country like India, I should get maybe 85 rupees. So these are exchange rates, and they are usually printed out, and you can Google them and you can see what is an exchange rate between these two countries, and you can get an idea as to like what it is. So these are just examples. They may not be the actual exchange rate. These are what we call nominal exchange rate. So nominal exchange rate is just the exchange rate between the two currencies. From here we get something, of course, because it's econ, we always have something called a real value. So there's always going to be something called a real exchange rate. And the real exchange rate, the formula for that is, let's call it real exchange rate, RE, equals to the nominal exchange rate times some domestic price index divided by the foreign price index. So what does this mean? Let's say that we are looking at an exchange rate between US and Canada. So US, let's say $1 will give me 1.5 Canadian dollars. So the nominal exchange rate is 1.5. So what we will do is write the nominal exchange rate to be 1.50. Next we have, what is the domestic price index? So the domestic price index is going to be the American price here, because we're looking at it from an American perspective, so it should be the American price here. And we're looking at, let's say, do we just have one product? Well, let's say we just have wheat, and to buy, let's say, 1 bushel of wheat in the US, it costs me $500. Then we will multiply $500 there. Finally, we have to divide it by now the foreign price index. So the foreign price index is what is the price of the same product in Canadian dollars. So in Canadian dollars, maybe 1 bushel of wheat is going to be, let's say it is 1,000 Canadian dollars. So if it's 1,000 Canadian dollars, we put that here, divided by that. And this is the foreign price index. So what is this formula doing? What are we trying to do here? So let's think about it this way. If I were to buy the same price, so the same amount of bushels in America, which is the domestic price index, using Canadian dollars, how much would I spend? That would be the numerator. And the denominator is basically what is the price of that same product in Canada in Canadian dollars. So when I solve this out, it would be 0.75 Canadian bushels per US bushel. Why did this switch? Because this was supposed to be Canadian. Why did it go up? Well, if I look at the way the formula is set up, 1 bushel equals 1,000 Canadian dollars, or basically this would be 1,000 Canadian dollars per Canadian bushel. Let me write Canadian bushel. And this one is going to be 1,000 or 500 per US bushel. So when I solve it, it should be 0.75 per US bushel divided by 1 per Canadian bushel. So then, because this is 1 divided by, and this was already per US bushel, so that's why they switch. So why is this important? What does real exchange rate help us to do? It helps us to find out where is it cheaper to buy a certain product. So if I were to buy 1 bushel of wheat, is it cheaper to buy it in the US or is it cheaper to buy it in Canada? Now, using US values and Canadian values, these are in US dollars and Canadian dollars. It's hard for me to see that. But what I can see is if I just multiply the US amount in Canadian dollars, which was 1.5, so 1.5 times 500 would be basically in Canada, basically the same amount would be 750 Canadian dollars. I can get the same 1 bushel, if I spend 1,000 Canadian dollars. So it seems like it is cheaper in the US. So then if I were to buy a bushel of wheat, I should actually buy it from the US because it's cheaper to buy it here. Or in other words, to see how this number helps us, let's say I have 1,000 Canadian dollars. With this, I can buy 1 bushel in Canada. Now, with the same amount, how much wheat can I buy in America? So in this case, I need to first convert this to US dollars. So it would be 1 US dollars or 1.5 Canadian dollars gets me 1 US dollar. Then 1,000 Canadian dollars should get me 1,000 divided by 1.5. If I have 1,000 Canadian dollars, I would get, if I exchange it to American dollars, it would be 666.67. Now with this, how much wheat can I buy? Well, 1 bushel of wheat was 500. So with this amount, I can buy more than 1. So it should be, I can buy 1.33 bushel in the US. So with 666.67 Canadian dollars, I can buy this much bushel in the US, or this much bushel of wheat in the US. So then if I want to see that real exchange rate, 1 divided by 1.33 gives me 0.75. So therefore, I can get less in Canada than in the US. So if the real exchange rate is less than 1, as we saw here, it's better to buy domestic. On the other hand, if real exchange rate is greater than 1, we should buy foreign. So this then helps us, real exchange rate helps us to figure out where it's cheaper to buy the product or not. Now from here, we get another concept called law of one price. This says that after we make sure, after adjusting for exchange rate, the price across the world for the same product should be the same. What this means is that, so let's take our example here. If Canadian bushel is comparatively more expensive than US bushels, if people keep on buying US bushels, so then price of US bushels will keep on going up, because demand of US bushels will go up, price of Canadian bushels will keep on going down, and it will equalize once the exchange rate or the real exchange rate becomes equal to 1. That means that at that point, it doesn't really matter if I buy domestic or American, or domestic or foreign. So how do we find that? So as we showed, if the real exchange rate equals 1, then my exchange rate times the domestic price divided by P star. Here, let me write it. P is domestic price and P star is foreign price. Eventually, it should give me this value. Or in other words, if I rearrange it, I can find E, that is the nominal exchange rate, will equal to P star over P. This is then giving me a very important formula. It is telling me that the nominal exchange rate is basically the ratio of the two countries' price index. Now, how does exchange rate and NCO and all these, how are they all related together? So let me just do a little recap what we have learned so far, because we have actually learned a lot of things. So here's a recap of all the things that we have learned so far. We learned that by rearranging the GDP equation, we get this, y minus c minus g equals I plus nx, where we are now calling y minus c minus g is savings. So replacing y minus c minus g with savings equals to s gives us savings equals investment plus net exports. Now we then introduce a new term called NCO, which is domestic residents buying foreign assets minus foreigners buying domestic assets. And so we are saying that NX now equals NCO, and plugging this value in here, we say savings equals I plus NCO. We also learned about the real exchange rate, which is equal to nominal exchange rate times the domestic price over the foreign price. So from here, these are all the things we learned so far. Now let's see how we can. So now let's look at the first equation that we came up with in this video. So we said savings equals investment plus net exports, or savings equals to investment plus NCO. So let's look at this value. So we can write it as savings equals investment plus NCO. Now this is basically forming from an equation. Let me just first draw the axes here. This part is telling us the demand for funds. So this is telling us how are we using our savings. So are we investing, or are we either buying or selling goods from our capital from abroad? This is going to be our supply of loanable funds. So this is determined by what we have here. So if we drew this, and again, this is dependent upon the price level, if it's a demand and supply curve, and the price level of funds, because it's capital, is going to be real interest rate. So my supply is going to be like this. This is coming from here. And the reason why it's upward sloping is because if interest rates go up, I am willing to then forego my current consumption, save that money so that I can get to buy more in the future. The demand for funds is then going to be downward sloping, and this is this value. So let's look at the demand part. Demand here is I plus NCO. Now let's say if interest rates are going up. If interest rates go up, then, or let's look at an example, if interest rate goes up from 3% to 7%, then in the domestic market, I may not invest as much, so my investment may decrease. However, on the other hand, if I see that interest rates are higher, foreigners may want to invest more into the domestic market. And we can see it here. Why? Because NCO is domestic residents buying foreign assets minus foreigners buying domestic assets. So NCO then will also decline. So it gets more negative. As a result, both of them will, as interest rates go up, these both numbers will fall, which means the demand curve is also going to fall. So then as interest rate goes up, my amount, the demand side, the demand for loanable funds will decline. If you want to think about it in words, if interest rate goes up, maybe domestic investment may fall, but seeing that I get a higher rate here, I may want to invest more into this country from abroad. Similarly, if interest rate decreases, so let's say it reverses from 7% to 2%, then my investment, domestic investment, will go up. Definitely, it will be more people will be willing to invest within America. And also what will happen is, now some people may find that there's too much or too low interest rate, or foreigners might find it is too low. So NCO will also become less negative. So as a result of that, it may actually go up. And so since both are going up, we can see then quantity demanded here going up. So we are moving to the right. So let's look at this part a little bit. Why is I plus NCO downward sloping? So let's take an interest rate. Let's say my interest rate goes up from 3% to 10%. If the interest rates are going up, so from here, let's say we go from this point to, or from this point upwards to this point, we can see that now it's more expensive to invest, so domestic investment of people may fall. On the other hand, because interest rates are higher, NCO is going to fall too. And the reason is, if interest rates are higher, because the formula is domestic residents buying foreign assets minus foreigners buying domestic assets, higher interest rates means foreigners are more willing to buy domestic assets. So with a higher rate that they can get, they are willing to put more money into the US. So as a result of that, this becomes more negative, investment falls. So we actually see our demand curve, or at least on this demand for loanable funds, we are actually moving to the left. Conversely, if the opposite happens, let's say interest rates falls from 10% to 5%, then domestic investment will definitely go up because demand for loanable funds will go up. People will want more. What will happen to NCO? It may be that other countries provide better investment opportunities, so NCO may also go up. It becomes more positive, and consequently, we see the opposite happening. As interest rates decline, we see more loanable funds. So from here now, we can see that how is this related to NCO? So because NCO is part of this, we can see that. So we look at real interest rate and quantity. So as a result of that, we can see that once the interest rate has been fixed right here, we can see this is the NCO. So even though this is just looking at NCO separately, although we can see that this includes I plus NCO, we can see now how changes in interest rate, how does that affect NCO. So let's say this is my equilibrium, and this is the quantity of NCO that is determined by this equilibrium. It could be a positive number or a negative number. So now we can see if anything happens to this NCO, if let's say supply of funds increase or decrease because savings change, then we can see what happens to interest rate and what will happen to the net capital outflow. Now let's say we are looking at a couple of scenarios. Let's say that for some reason people are saving more in the country, so savings increase. If savings are increasing in the country, so more people they're not spending as much, so savings then will shift to the right. If savings shifts to the right, we can see that demand for loanable funds stays the same, so my interest rates will decline. As a result of that, how is that going to affect net capital outflow? We can see that with a decline in interest rate, net capital outflow will become more positive. What this means is that we are getting more positive, so then domestic residents are then willing to buy more of foreign assets, because it may be that foreign assets interest rates are much higher than domestic assets, so it's more lucrative to buy foreign assets. Foreigners, seeing that interest rates are lower in America, may not invest as much, So therefore, NCO becomes more positive. Let's look at another example where let's say that the US government has given much more incentives for domestic investments. So maybe there's like tax breaks, and maybe there's government is promising that we are going to train more people in America to meet the needs for investment. So let's say as a result of that, investment increase. So I has gone up. So if I has gone up, then as a result of that, because more people are willing to invest, let's say the demand curve shifts to the right. So if the demand curve shifts to the right, we can see that now, because there's more willingness to invest, the real interest rate is going to go up. So as more people are willing to invest in the US, foreigners also see that the real interest rate has increased. Consequently, what they will do is try to invest more in America. So NCO gets more negative, which means that more foreigners are now sending money into the US to take advantage of this higher interest rate. Now, this was only because I went up. Now, what if my country is not doing so well and I want to move capital outside of my country? So because D equals I plus NCO, as we can see that, it will also create an increase in demand. This is going to be a demand for funds, but this demand is not for increasing I. So let's say what we say, if let's say NCO increases. So I want more to leave the country, let's say. Then if that happens, it means that my NCO curve is going to shift to the right. Because I may feel like this country is not safe enough for me, I want to take the money from this country and leave the country. So as a result of that, interest rates go up because the local currency or the local country wants to keep the country within, or wants to keep the money within the country, so will pay a higher interest rate. So with rising interest rates that we see here, what may happen is that now with higher interest rate, government is trying to keep the money within the country, but it may not work, and we may still see Q star star, which may show that NCO becomes more positive. So domestic residents are taking money away and buying more of foreign assets. So we can see now how loanable funds market and NCO are related. Next comes from here, as we saw, there is a relationship with exchange rate as we were talking about. So let's add exchange rate down in the bottom right here. So if we look at quantity of dollars, this is now in the exchange rate of market. So this is going to be the quantity, and this is going to be the real exchange rate. So the demand for exchange rate is going to be downward sloping. If price is much higher, people will want less dollars. Let me write quantity of dollars. When we said real exchange rate was equal to 1, we really didn't care about US goods or foreign goods. If real exchange rate was less than 1, we tended to buy more of US goods. So therefore, quantity of dollars, we need more of that. If real exchange rate was greater than 1, we wanted to buy more of foreign goods. So then we would need less US dollars. And of course, when we say more dollars and less dollars in the market, we mean that this is the market for exchanging dollars for some other currency. So in this case, so the NCO basically, if we look at where the quantity is, the NCO, the inflow and outflow, determines the supply. So as we can see, this is the quantity of US dollars available for moving in and out of the US. So if NCO and exchange rate are now shown to affect each other, let's actually draw it in this way. It might be a little easier to look at it. So as we see here, this is the real interest rate, and this is the quantity of dollars. This is also real interest rate. This is quantity of dollars, but this is now real exchange rate. and this is the quantity of dollars. So from here we saw that the interaction of supply and demand, this was the supply from savings, and this is I plus NCO. This provided the demand and supply for the funds, and then this determined the interest rate. This interest rate then determined my NCO. We have NCO already embedded in this curve, but we want to see it separately because NCO does help us to look into what is happening to, we want to see separately what is happening to the inflow and outflow of funds within the US and within US and other countries. Now, this amount, this quantity determined, so this is giving me a value of NCO. Now, this then gives us, because of this is the trade of dollars or foreign currencies in and out. So if I look at US and Germany, this NCO is determining how much US dollars is going to Germany and how much euros is coming. So this amount determines the supply of funds in the exchange market. And then we have the exchange rate, which is going to be the demand for exchange rate is this, and this is the supply. So this then determines the interaction of the supply and the demand curve determines the real exchange rate. Let's look at that again. Let's say that savings increased. So we see savings in the US increased. As savings goes up, this curve will shift to the right. So we see that real interest rate will decline and quantity of investment increases. If real interest rates decline, we see that NCO then becomes more positive. So NCO now moves to Q star star, the green part. So this is now my NCO. As a result of that, since NCO increased, we see that this is the amount available in the exchange market. So there is more dollars available in the exchange market. The reason is, well, if interest rates are declining, fewer foreigners will want to buy US assets. And as a result of that, and maybe more Americans will be wanting to buy foreign assets. So NCO equals US citizens buying foreign assets minus foreigners buying US assets. So falling interest rates means this will decrease and this will go up. So this number, one is going up, one is going down. So this then becomes more positive. As a result of that, there is more dollars available for trading in the exchange rate market. Supply of dollars increase. We see real exchange rate decline from E star to E star star. So as a result of that, if E star declines to E star star, and so we may see then NX is also going to get more positive. And why is that? Because we said before NX equals NCO. So this is one thing that could happen is like if we increase savings. Now let's say we increased invest. So now we saw on the first example how savings was affected. Now let's say that investment increased because the US government is making more making policies to increase investment. So as a result of that, demand for investment will increase, and this is because I went up, not NCO. So if demand goes up, interest rate will increase. Consequently, we will see there's going to be a decline in NCO. This is because interest rates going up, so foreigners are going to buy more of US assets. US citizens also may invest more in the US, so they both decrease, and so NCO falls. As a result of that, if NCO shifts to, let's write it, Q star star, then right here in the exchange rate market, we will see that NCO is going to be at this point. So then we see my real exchange rate initially was here, now it will increase too. So consequently, we will see since NCO has become less or has become more negative or has fallen, so net export will also become more negative. Finally, let's look at another example. Let's say demand for dollars went up, but this time it went up because NCO is going up. People want to take money away from their home country and take it abroad. And we looked at that example. We said that interest rates will go up to keep the money within the country. So as a result of that, NCO shifts to the right because more people, for every interest rate, they want to move more money out of the country. So consequently, as we can see, NCO then, because real interest rates went up, NCO was here, now it is. And because of that, we see that to keep this interest rate, we have, so because real interest rates went up, to keep the money in, some people may keep the money in, but some people may take the money out. So we may see an increase in Q, so it may move up to here. And as a result of that, we can see that our supply of funds in the exchange rate market may go up to here, and this too. And this amount is Q star star star. And so we see then the real exchange rate falling as a result of that, which makes sense intuitively. If I want to take money out of the country, so I'm converting, let's say, my dollars to a foreign currency. So as a result of that, my dollars will not be able to get enough of foreign currency. Hopefully this was beneficial. I'll see you at a later video. Have a good day. Goodbye.